and this podcast is for informational and educational purposes only and does not constitute financial advice. Please consult with a qualified financial professional for advice specific to your situation. The views and opinions expressed are those of the hosts and guests and do not necessarily reflect those of the podcast producers or sponsors. We make no representations or warranties regarding the accuracy or completeness of the content. Hi, my name is Bella Carrasco, and helping others feel confident about investing brings a huge smile to my face. After working in the private equity, family office, and securities markets for nearly a decade, I am breaking down the world of money, investing, and financial freedom. Work optionality isn't a dream. It's a decision you make today. I bring you actionable tips, expert interviews, and enlightening strategies to help you get richer and stay that way. This is the How Do You Know podcast. Today we are speaking with Josh Radman, who is a fiduciary, certified planner, and enrolled agent, which just means this qualifies him to prepare tax returns and give tax advice. But he hasn't always been in this life. After graduating from Harvard Business School and entering the tech industry, he had trouble finding someone who could help him with his equity questions and decided to make a career pivot and become an advisor to help those in similar situations. So now he guides clients through tax optimization, equity strategy, and broader financial planning. So Josh, thank you for being here.
I appreciate you having me.
To begin with, there are lots of acronyms specific to tech employees. So can we start by defining some of those, like RSUs, ISOs, NSOs?
Yeah, RSUs, ISOs, NSOs, those are the big ones. So we'll start kind of from the simplest and then we'll work our way to the hardest. RSUs are generally the most straightforward. Essentially what that means is you have shares in a company that are restricted until a certain, let's call it timing or performance metric is hit. What's nice about RSUs is you don't actually have to buy them, right? So they are shares that are granted to you. And then, if your company becomes public, then perhaps they vest, or if you hit a certain milestone, then they vest. If you're already in a public company, typically there's only this time-based vest component. So those are RSUs. Then you have NSOs. NSOs are non-qualified stock options. They give you the right, but not the obligation to buy. They can be very valuable, but they can also go to zero, right? So if they are granted to you at a price that eventually the company is no longer worth, then they're considered, underwater, and you can exercise them. Essentially, you can buy them, but they're not worth anything. So there's a lot of upside. There's a lot of downside with NSOs, non-qualified stock options as well.
And then just really ISOs. Quickly, sorry to interrupt you. Is there one sentence that describes the difference between RSUs and NSOs? Because they almost seem pretty similar.
RSUs are shares, NSOs are options. Got it. RSUs, you just get them. NSOs, you can decide whether you want them or not, but you don't actually have to buy them. You have to actually purchase NSOs. RSUs, you do not have to purchase. That was more than one sentence, but that's my that's my consolidated breakdown.
All right, thanks. Yep. Now into ISOs, which sounds like it might be the most complicated.
Yes, so they are potentially the most tax advantageous, but also by far the trickiest. They can only be given to employees of companies. So if you're an advisor, you're going to get non-qualified stock options potentially as part of your equity. So only employees are getting ISOs, typically in venture-backed companies. If you meet some of the requirements, there are generally two. One is you have to sell at least 2 years after the grant date and at least 1 year after you've exercised. This is kind of getting in the weeds, but if you meet these holding requirements, you can generate long-term capital gains, which is a benefit. However, there's also the potential to generate what's known as AMT, alternative minimum tax. RSUs and NSOs, you almost never have to worry about AMT. ISOs, it is something that you need to be cognizant of. And you could potentially generate AMT, but it's not, you may not. So there's kind of this window of opportunity in which you can exercise some ISOs and essentially pay no tax, no AMT, up to a certain crossover point.
Okay. So is there a way to avoid AMT altogether?
There is a way to avoid AMT altogether. Yeah. So if we take a step back, there are actually two parallel tax systems in the US. You've probably only heard of one, which is kind of the regular tax system. But every year, what's happening is in the background, there are two calculations running, one for the alternative minimum tax system and one for the regular tax system. You pay whichever of the one is higher. If you've never paid AMT before, it's because your regular income tax has always been higher than your alternative minimum income tax. Now, with ISOs, when you exercise them, that counts towards your alternative minimum taxable income. So it increases that amount and gets you closer to that
Mm.
regular tax threshold. And if you increase enough of your ISOs, then it goes above the regular income tax threshold and you owe the delta. Now, if you exercise ISOs, and let's say your AMT is here, or your AMTI, alternative minimum taxable income, is here, your regular taxable income is here. And for those who are listening on audio, I apologize. I'm using my hands in kind of funky ways. There's this gap, right? So this gap you can fill by exercising ISOs. The spread, which is the difference between the fair market value and the 409A, counts towards that gap. But as long as that gap is lower than the total amount that you're paying in regular income tax, you're not going to owe anything. As soon as you hit that threshold where your AMT income equals your regular income and above, that's when you start to pay AMT. So there's typically a window of opportunity. And what this means is kind of a window of opportunity where you don't have to pay tax on your ISOs. If you generate, or if you have a year in which you have a lot of regular tax dues, so for example, you exercise ISOs or you have a lot of RSUs that vest, then that might be a really good year to exercise more of your ISOs because your regular tax is already really high. And so it gives you more room to exercise ISOs without generating AMT.
Okay. And are the AMT tax rates the same as regular tax rates?
No, they're not. So
Okay.
AMT is taxed at a 26 to 28% rate. Your
Oh.
federal taxes are range from anywhere from zero, I think it's 0, 12, 22, 24, 32, 37, if I'm not
Mm.
mistaken there. So kind of depends on where you're at.
I see. Okay. And are you still taxed on ISOs that you don't exercise at all? Is it
No,
simply just the performance? Okay. It's
no,
just when you actually.
it's only when you exercise, right? There's no
Okay.
tax on grant. There
Okay.
is a tax on exercise. And then when you sell, that's where capital gains come in because now you have
Got it.
once you've exercised your right to purchase the options. The options now become shares. You have ownership in the company, just like shares of any private or public company that that you can purchase. And then when you sell them, you have capital gains on the difference between what you bought it for and what you sold it for.
In addition to the AMT.
Correct.
Okay.
Correct. So the AMT is charged, and it's complicated. Sometimes like there are ways where you can not owe AMT in a what's called a disqualifying disposition. We're getting really into the weeds here, and you'll only owe income or capital gains tax. But yes, AMT is not a guaranteed. If you hold it for longer than a year or through the calendar year, then you can potentially be subject to AMT. But if you work with a tax strategist, this is, and I consider myself a tax strategist, this is where we're kind of figuring out, okay,
Hmm.
what's the optimal amount of ISOs we want to exercise this year? What do we want to do to potentially increase the number of ISOs to exercise? Or is there actually a good reason to deliberately generate AMT in 2025 because the tax laws are changing in 2026? And
Mm.
for tech professionals, the particularly around AMT, there's a lower phase out amount. The rate at which the exemption phases out it becomes higher. So there can sometimes be good reason to actually deliberately pay AMT in one particular year.
Sounds like it's an art and a science.
It's an art and a science. Not to add more confusion, but AMT is almost known as a prepayment tax because you can recoup that sometimes when your shares are sold. So that's part of the calculus as well. But you're
Mm.
totally right. There's definitely the quantitative part, and then there's like the qualitative. What makes sense for you right now? Do we have the cash flow to do this? Let's talk about what fits your lifestyle.
I'm going to withhold my urge to go down a very deep AMT hole right now. So I'm going to bring
That's
us
smart.
back to the
That's smart.
to the acronyms that we started with. So what is the best balance in terms of salary and stock compensation that you typically guide your clients to?
It's a good question. I think there's no one right answer, obviously,
Hmm.
but the way I think about this is through a regret minimization lens. So I'll tell my clients, let's think about your current situation, right? At this stage of your life, your priorities are whatever, fill in the blank. And given that you have, I don't know, debt to pay off, you've got kids to feed, maybe none of that, you have total flexibility, right? That's a component. And then let's think about your goals. Like, what are your goals? You want to take really big bets, buy a house, pay for a wedding. So think about kind of all those different aspects and then ask yourself, okay, what would you regret less? One is you
Hmm.
optimize for salary and the company goes to the moon, okay? Or two is you optimize for equity and your equity turns out to be worth nothing. Um, which is, by the way, the modal outcome for VC-backed startup equity is $0.00.
Oh my
So
gosh.
generally, I think optimizing for salary is probably the financially savvy thing to do, but it's a very personal situation, and not everybody is. You have to think about, okay, why are you joining this startup in the first place? Is it really
Mm,
just to have the highest payout amount, or is it because you want to rub shoulders with people who are breaking old models? You want to develop leadership skills. You don't want to be a cog in the wheel at a larger firm. um, I'm kind of getting off track, but I also think that one thing to consider is people forget about refresh grants. So there's a statistic out there from, I think it's Carta. 70% of startup employees, those who make it to the end of their initial equity grant, typically 4 years, they're going to receive an additional refresh grant. So it's not like if you choose one or the other, you can't get more equity down the line, or you can't
nice.
ask for a salary. But
Sure.
I think it's important. Consider your financial situation. Consider the fact that most equity is worthless. Consider why you're interested in this company. And then think about, if the company does really well, you're probably going to do really well too. Like, there's a lot of upside. You're going to keep your job. You're going to get promoted. You're going to get refresh grants. So, like, you're not going to be
Okay.
hurting. But
Yep.
if the company ends up not doing the way that you thought they were going to do, would you regret that you took this lower salary? Your equity is now worth nothing. You've put in all this, blood,
Yeah.
sweat, and tears, and here you are.
It really puts it into perspective. And one
Yep.
of the quotes that come into my mind is you can't eat equity. So you still have
Yep.
bills to pay and
That's right.
groceries and all that and all those factors to consider.
Definitely.
What about exercising the stock options? Is it kind of the same framework? When should people sell? What are the tax implications? Are there any tranches people should prioritize?
Yeah. So here's what I think. Um, I would say. So you want to sell. You should exercise your stock options if three things are true. One, you are incredibly bullish on your company. That's first and foremost. Like, this has to be an investment decision when you are exercising, because you are buying. You are literally making an investment into your company. So exercise your stock options if you're super bullish on your company, you've got a low opportunity cost, and you have the cash to do so. Sell your shares. And so, like, sometimes you may not even be able to sell shares, especially at private companies. It's not a liquid market. Sell your shares if two things are true. One is you have a good use case for the cash, right? So, like, okay, I want to do a home remodel. I want to remodel my basement. I need cash to be able to do that. Okay, that's a great reason to sell your shares. Or you want to put a down payment on a house, or you want to pay for upcoming wedding, or like you want to save for your kids' college expenses, right?
Hmm.
Two is if you're heavily concentrated in one position, and I define
Yes.
concentration as anything more than, let's call it, 10 to 15%. Um, then you should be looking at ways to diversify your holdings. People forget that 75% of individual stocks, and this is like look at the top 3,000 stocks, publicly traded stocks from the past 100 years or so. 75% of them on average are underperforming their broader index. And actually, the data will show you that the average return on any one particular stock is negative 11%, right? Like it's actually, the average stock actually generates negative returns. So I think people underestimate the volatility and the risk of holding single equity positions. And so if you are super concentrated and, your company had an IPO or an acquisition or whatever it may be, like if you're holding a lot of company stock, then you should probably be looking at ways to diversify. And I think your other question was like, how do we prioritize the various tranches? It depends. That's a crappy answer, but typically I would say the tranches that have capital losses, so basically they're worth less than when they vested, we want to sell those and harvest the losses there. And then I'd say if you have gains, often what I'm working with clients to do is to figure out which tranches have the lowest percentage of gain, not a dollar number, but lowest percentage. And this is going to create the lowest tax impact per share. Mm-hmm. And then we're looking at, okay, which ones can we sell? What's our total capital gain? How does that offset against some of the capital losses, and kind of what's our total bill? That's kind of the high level rule of thumb. When you have incentive stock options, as you can imagine from our earlier discussion, like things start to get tricky because incentive stock options, they have multiple cost bases. They have one for AMT purposes. They've got one for regular purposes. I briefly hinted at the fact that you can recoup some of the AMT that you generated. That's when this comes into play. So that's when you really have to work with a tax professional or a tax strategist or CPA or whoever it is to figure out, okay, what am I going to be able to recoup? What does that mean for my total tax bill, and how many more ISOs I can potentially exercise that year without generating AMT? I will also say I see a lot of errors on tax returns, right?
Oh,
so you have to find somebody who works with, if you're talking about AMT and ISOs and private company equity, find a strategist and an accountant who sees this stuff day in and day out. Because otherwise, even though, yes, they're qualified, if they're not seeing this, if they're not super familiar with what's going on, there's a lot of nuances, and I see errors all the time. So for example, like I don't work with real estate moguls, right? If you have a couple properties, no problem. But if you have a lot of real estate, you should find a strategist who is super familiar with real estate,
right?
And a CPA or a tax preparer who is super familiar with real estate. Same thing with equity comp, because these are very specialized niches. Like the analogy I would say is, if you had a heart condition, would you go see a general practitioner or a cardiologist?
Right.
You want to see a cardiologist because, yes, the general practitioner might be able to get 70% of it, but you need this specialist to really help you kind of get the level of output that you deserve.
Right. It makes sense that the answer is it depends, because not only are different clients in different stages of life, but as you just mentioned, there's so many different complications between RSUs, ISOs, the different tranches, the different taxations, and when to sell. So definitely need to see is someone that is specialized, someone who is not a jack of all trades, but is going an inch wide and a mile deep, because that's someone who you're going to want on your team. But interesting that you mentioned real estate, because one of the questions that popped into my mind was, how can you use real estate to maybe offset some of these tax implications? And I know that in past conversations with you, it sounds like real estate doesn't make sense in this scenario. So if you could dive into that a little bit too, that would be interesting.
Yeah. So this one's juicy, and I wouldn't say it doesn't make sense, right? Like, this is a personal, we really have to think about, I think, more than the tax implications here. Like, I'm going to say this tongue in cheek, but like, when was the last time your diversified portfolio of index funds called you in the middle of the night because there was a water line leak, right? Like, you have to be, like, you might have some personal experience. You have to you have to be cognizant of the fact that there's more to this than just buying
Yes.
a piece of property. And I think people get generally, I'm making a generalization. We get excited about short-term rental loophole that we've heard about, and by bonus depreciation, right? Tax savings. Why would we not take advantage of them? But it's easy to start to let the tax tail wag the investment dog, and
Yeah.
just because you end up with a nice tax deduction doesn't mean that you're going to be better off over the course of your life. And like I think that my goal is really to help folks think about how do we make a decision where you can look back in a few years and feel like the investment truly advanced your long-term financial goals and wasn't just limited to a hit on your 2025 tax bill that looked
Hmm.
good, but really the juice wasn't worth the squeeze. Because what are we optimizing for? We're not optimizing for 2025 or 2026 taxes. We're optimizing for the greatest after tax wealth over the course of your lifetime. And
Yeah.
a lot of these strategies are deferral strategies. So at some point, you're going to have to you're going to have to pay the tax man. And a lot
Hmm.
of time with real estate, you have to recoup depreciation losses. So this comes down to a tax arbitrage strategy. And the
Mm.
arbitrage has to do with your tax rate in one particular year versus your tax rate in another particular year.
Yeah.
So that's kind of high level. We can talk about bonus depreciation if you want, and kind of how I think about that, or short term, rental loopholes, or like how I approach these situations. But I kind of leave it to you here.
Sure. Well, yeah, let's talk quickly about bonus depreciation. How do you typically handle that?
So bonus depreciation is exciting, right? Because you get to expense a lot more in theory up front versus over the lifetime of the property, or kind of the assets of the property. I like to think about, instead of starting with, oh my God, I think I could get this potential massive bonus depreciation deduction in 2025. I tell my clients, hey, let's invert the problem, right? Rather than starting with the potential deduction and then trying to find a property to capitalize on this, said deduction, show me a property that makes financial sense on its own merits. Okay. Then let's see how the deduction can then strengthen the economics. And
Hmm.
I'll give you an analogy here. And I'm going to apologize to you and all of your listeners if you drive a Nissan Leaf, because I'm going to, you'll see. But let's assume like Nissan offers you this cool package where they will install a free home charger. They're going to cover all your charging costs for a year, the electricity, everything else, if you buy a Nissan Leaf. Okay, that's a pretty solid incentive, and it's maybe worth, I don't know, $10,000, $15,000, right? But at the end of the day, you still have to want to drive a Nissan Leaf, right?
Yeah.
Like, if you don't, that incentive doesn't suddenly make buying it a good opportunity. And I think the same is true with bonus depreciation, right? The tax deduction, the savings shouldn't be the deciding factor on a piece of property. It needs to enhance the property, and beyond the economics that already pencil out. So basically, what I tell my clients is, okay, if you're interested in buying a property, cool, like I'm all for it. But let's start by looking at the specific property. Let's start by looking at the cash flow, the appreciation potential, the ROI. If you want to run a cost segregation study, great, but like that's not free either. So let's factor that in.
Mm.
Then once we have a baseline, we can start to model out bonus depreciation, some of the other tax factors that could affect your after tax returns. And then, like, remember this, right? Bonus depreciation, it's a deduction, it's not a credit. So that means if you get a $100,000 deduction and you're in the 37% tax bracket, that offsets, let's call it 37K at that marginal federal rate. But then typically, when you go to sell the property, call it 25,000 of that has to be recouped through depreciation recapture. So it might actually be a lot smaller benefit than you think. You
Hmm.
also have to remember your rental property income is taxed as ordinary income, right? So if you're in a 37% bracket, if you're in the highest bracket, you're paying, that tax on that income versus equities where, the gains could compound tax deferred. It could be managed strategically. So that could make a difference. Liquidity and time, right? Those are also factors. Who's going to manage it? harder to unwind a big real estate purchase versus equities if priorities change. I don't want to sound like I'm poo-pooing real estate at all, but we just have to, like, I want my clients to go in with the widest possible lens, eyes wide open. We often hear about the benefits of real estate. There's a lot of hassle factor
Yep.
that is also part of it, and we have to think about that. And then there's also like just the nuances of how does the tax actually work. It's not going to offset, any of your AMT. It's not going to offset, generally speaking, any of your ordinary income, because it is a passive income, right? Passive
Yep.
income needs passive losses. Unless you are a real estate professional, you have real estate professional status, which is very difficult to get, or you have short-term rental loophole, which is also burdensome in itself.
Yeah.
We can talk about that too if you want.
No, I like this framing of don't let the tax tail wag the dog because, like you said, first we need to make sure that it cash flows. How do the numbers look, et
Right.
cetera, et cetera. But also, I like the word hassle. What hassle are you willing to put yourself through? Because I think there is a common misconception that, oh, I can lower my W-2 income with this income from, or any losses potentially from the real estate. And like you mentioned, that actually isn't true. So it's asking yourself, is dealing with tenants, toilets, and trash really worth the
Yes.
hassle? So,
Right. So,
I yeah, go ahead. Sorry.
I was going to say, like, here's the questions that I pose to my clients. One, do you, like, aside from the tax benefits, right? Like, do you genuinely enjoy the idea of being a landlord and
Yeah.
hands on with this rental property? Okay. Two is, like, are you prepared for the reality of managing the maintenance, the tenants? Like, is this going to cause
Hmm.
stress? And if you already have a lot of stress or like not that much time, what is the return on hassle factor here?
Yep.
Like, this is going to occupy a lot of headspace. So are you ready for that? Um, is it, this is more for like short-term rental loophole, but is it close enough for you to be materially involved?
Mm,
You cannot outsource this to a management company because you're not going to pass the threshold for short-term
right.
rental loophole, right? So you have to be the one who is managing this property day in and day out. How much time do you really want to sink into this? Maybe
Yeah.
you do. Like, maybe this is your dream. And if so, like, great, it could make a lot of sense. If you're preoccupied with other things, oh boy, like I've seen a lot of clients really regret getting into this, not knowing kind
Hmm.
of the amount of effort and like headspace that it took in.
Right. Yeah. And if you have anyone that needs a more clear definition on what it means to be a landlord, just have them call me and I'll tell them all the dirty secrets. But going off of the tax implications, what are some easy tips people can use to reduce their tax bill, or what's your overall approach to tax planning?
Yeah, so we touched on this a little bit, but I think that people forget that tax strategy, it's not necessarily about getting the biggest deduction in any one particular year. Tax
Yeah.
strategy is about paying the lowest amount of taxes over your lifetime, right? So again, going back to this tax arbitrage concept, I could tell you to max out your traditional 401k, right, which would give you a deduction, buy real estate, use bonus depreciation 2025. But if you're in a particularly low tax bracket this year, like that actually might not be a great strategy. So net, like we get preoccupied with what can we do today,
Yeah.
but really the most important thing is uh, what do we do to maximize our after-tax wealth over our lifetime. Remember that a lot of these strategies, again, are deferral strategies. They're not avoidance strategies. Eventually, you have to pay the tax. If you're going to be in a higher tax bracket down the road, then that is a consideration.
Hmm.
So it's, yeah, I would just say, think about this, think about taxes, not about one particular year, but over the course of your lifetime, zoom out and really make sure you understand the nuances of some of the arbitrage that we're trying to take advantage of.
I really want to double click on the zooming out because I think a lot of us are so short term focused that
Yeah.
I love that your concept of like, okay, let's actually think about it over your goals, your lifetime. Where do you want to be in 20, 30, 40 years
Yep.
rather than just 2025.
Yep.
And also earlier you mentioned this notion of diversification. So if you're maybe too concentrated in your stock, let's divest that and maybe invest that elsewhere. Is there a way to take your company stock and invest that into something else without paying taxes? I know that there's QOZ programs out there where you
Yes.
can essentially do that in a way. I know you have to pay the taxes at some point, but I don't know, is there a way for managers out there to create some sort of ecosystem for people to divest of stocks and have that be a tax-free exchange?
I would wish, or I
Yeah.
wish. So you're probably thinking about 1031 exchanges for real estate
Yeah,
potentially, or
something like
like,
similar like that. Yeah,
yeah, or
exactly.
like Peter Thiel, in his $5 billion Roth IRA, right? So like in that situation, the only thing that you can go into your IRA accounts is cash, right? So you can't transfer
Mm,
cash into, or sorry, you can't transfer stock into your IRA, but in some cases, you can actually take the cash that's in your IRA and then go buy private investments and have those grow. And that's what Peter Thiel did with, what was it, eBay or PayPal or something, and then like it ballooned, right? But that was a bet that he made. Remember what the modal outcome of VC-backed equity is generally worth. It's zero. So you have to think about that. But there are some opportunities to move things around. What comes to mind is something called qualified small business stock. This is kind of in very rare circumstances where you invested really early on in the company, you met a couple of criteria, you've now have $10 million or more of potential gains. You can start to do what's called QSBS stacking or packing, and kind of move assets around in that regard. That's probably the closest thing that comes to mind, but this is few and far between.
okay. And in the spirit of the long-term thinking, are there any withholdings that people should like should it be zero withholding to avoid tax surprises in April?
No, yeah. So a couple of good points on withholding. For RSUs, these are restricted stock units. When they vest, so like let's say you have an IPO and suddenly all of your RSUs vest on IPO, sometimes you can elect different withholdings. Typically, it's either a 22% or a 37%. Your company is often going to default to 22% withholding, but most folks here, or I'm making an assumption, but I assume that many of your listeners are going to be in a higher federal tax bracket than 22%, which means that there's going to be an automatic under withholding. So company withholds, let's say $100,000. You have $100,000 vest. They withhold 22,000. You're in the 32% tax bracket. That means that actually you owed $32,000. Company only withheld 22. You think you're good. Come April, you've got a $10,000 tax liability that you owe. So with RSUs and bonuses, for that matter, you have to be careful about having an excess liability and under withholding. And companies generally, unless your income is over $1 million, they're not going to withhold enough. So that's
Mm,
one thing on withholding to be aware of. The second thing is, if you're a small business owner, if you have a big capital gain or sale, you have to be making estimated taxes throughout the year on a pro rata, or kind of on an equal basis in Q1, Q2, Q3, and Q4. There's something called safe harbor. So safe harbor means that, with a few exceptions, particularly on the state level, you have to pay at least 90% of your tax liability in 2025, or you must have paid at least 110% of last year's tax liability. That gets you to this threshold where you don't have to pay more. You're going to owe more tax, but there's not going to be a penalty if you don't pay enough. So, in terms of withholdings or estimated tax payments, you need to be making these, like equitably throughout the year. And you should work with a tax strategist. And I don't think I clarified this, but a tax strategist is more forward looking, right? We're looking at what should we be doing? What is our strategy this year? Generally, a CPA is more backwards looking, where they're like, hey, Bella, tell me what you did this past year, and I'll just
Mm-hmm.
write it down and make sure it's done accurately. You kind of need two to tango. You need the
Yeah.
strategist to help you figure out what you should be doing, and you need the CPA or the enrolled agent to help make sure that they're filed correctly. So work with a strategist who can help you understand kind of what your safe harbor amount is, what you should be paying each quarter, particularly small business owners and those who have big capital gains.
Yeah. So bottom line, please use a tax strategist.
Yeah, exactly. Or like be subject to penalties, but like why would you pay the extra, couple grand when somebody can help you throughout the year and just make sure to keep you on track? This person should know kind of your situation intimately, and there are all sorts of plays, particularly if you have your own business, on what to withhold, what not, when to do the withholdings. There are a couple of interesting plays here. But yeah, that's mostly for those, I would say, mostly for those who have bonuses, commissions, RSUs vesting. That's when you have to be really careful about under withholdings. And then small business owners or those who had capital, who had a big sale throughout the year. If you're just kind of standard
Yep.
W-2 employee, didn't have any of those, your company generally should be withholding approximately the right amount.
Perfect. Yeah, those are helpful guidelines. All right, well, let's end with my 3 question fire round. The first will be, what is a favorite piece of media you've consumed recently?
Okay, so there's a book and then there was a podcast. The book is called Die with Zero by Bill Perkins. It's basically
Hmm.
about how do you maximize your life experiences versus accumulating a ton of wealth and then dying with a ton of money. Right? There's no prize for getting buried with the most amount of money. So how do you strategically use your wealth throughout your life, and when should you be doing that? A lot of people
Mm-hmm.
save a lot, save a lot, save a lot, and then it goes to their kids. And it's like, well, I'm sure your kids are appreciative of the inheritance at age 65, but like maybe they really could have used that cash when they were 35, or like maybe you could have gone on vacation and done a ton more things and generated all these memories with your
Yeah.
family when you were healthy, right? So how do you strike that balance between making sure you have enough, but also making sure that you maximize your life happiness?
Yeah.
So really interesting book. He did not. I have no connection with him, but like, yeah, I think Die with Zero is interesting. Look it up. There are some podcasts where you can basically get the gist in an hour and a half if you don't like to read.
That's brilliant. Yeah, sounds like a really good reflection piece.
I think it's really interesting and particularly interesting for parents, right?
Yeah.
Like, and especially frugal parents of like, hey, this is kind of a different perspective. Anyway, we don't have to get into those details.
Well, at least we have the option of listening to it or reading it, so the
Right.
people can digest
Yep.
it either way.
Yep. Exactly.
Second question, if you could invest $100,000 today outside of yourself, how would you allocate it?
I knew you were going to ask me this question, and I still like, I'm not. Okay, here's my best bad answer, which is okay. Depends on the time horizon. Boo! Like, what a crappy response. If it's a long-term investment, I like simplicity. So I'm going with a very simple, low-cost, broadly diversified ETF, not a mutual fund, an
Yep,
ETF. I'm going to stick it in there. I'm not going to think about it for years and years, and I'm just going to call it good. And yeah, I'm not going to no hassle there.
and why not a mutual fund?
Mutual funds, a couple of reasons. They're generally less tax efficient.
Mm,
They only trade at the end of the day. So, for
I
example, if there
see.
are like tax loss harvesting opportunities
Sure.
that come through midday, we saw a bunch of them early in April and March. A lot harder to do with mutual funds. So there's a couple different reasons for them, but I think those are like broadly speaking the top two.
Yeah, those are some good reasons.
There you go.
Third question, how do you stay up to date on financial news?
On financial news or tax news, it's different, right? But podcasts, so walking the dog, or I've got a newborn at home. I got one of the year feeding him, kind of trying to maximize my time. Um, I There's one out there. It's called Prof G Markets. I don't know if you've listened to it. It's with like Scott
Mm,
Galloway. It's interesting. It's an interesting take. So I've been listening to that one recently. Here's what I would say about financial news, because typically when I listen to financial news, I immediately go in and check my, brokerage accounts on like, okay, wow, this stock or this fund has dropped or this one's up. What I would tell your listeners and my clients is if you're checking your brokerage account more than you're flossing, you're doing this backwards. Okay. So like check the financial news, don't check your bank accounts. Don't worry about that. But yes, it is important to stay up to speed with what's going on.
It's also hard because in this day and age, I feel like media is so driven by how many clicks you can get, and
totally.
so the headlines are scary and clickbaity.
Yeah.
So yeah.
It's terrible. So I mean, as a financial professional, like I have to stay up to date with some of those things.
Yeah, of course.
But I also really encourage, like we are setting set it and forget it strategies by and large, unless there are big market drops where we have tax loss harvesting opportunities. But like, because it is so clickbaity, it's so easy to get in and over our heads on this stuff. And so how do we simplify this? Like the return on hassle, the headspace premium that we generate is often worth a ton.
Absolutely. Yes. There's nothing that will ever, what were those, was it Visa that had those commercials that like, I don't know, a coffee, $5, this $10, something else priceless.
Yes, exactly.
Yeah, so take care of those priceless moments for yourself.
Totally. Right. Like we're all busy. We have so many other things to do. Like we should not be overly focused about some of our, individual stock holdings. And if we are, that's a good sign that we're probably over concentrated in something, and we should be doing something about it.
Sure. Yeah. Good point. Well, Josh, thank you so much for your time. Why and how should people reach out to you?
Reach out to me if you need help with your equity comp, or B, a lot of my clients, like they just don't have the time anymore or the interest or the expertise to manage their finances. Like they're busy. They've got families. They've got really stressful jobs. They could probably, do this on their own, but their household income is maybe approaching, $300,000, $400,000, right? And that means their hourly rate is, $250 an hour. So if they're spending just 2 hours a week finagling on their finances, like they're spending 50 to 20 grand worth of their time on something. And if you're tired of doing that, let's have a conversation. I'm happy to chat. I'm also happy to just be a sounding board, point people in the right direction, help people understand like what you should look for if you need help with a financial planner, and also like who you should avoid. There's a lot of folks out there who are just selling things, right? And it's hard to interpret who's selling what, like who actually has my best interest. And so I'm happy to, share my perspective on that. As you mentioned earlier, I'm a fiduciary. I'm a fee only fiduciary, which means I only make fees out of the fees that I, charge my clients, and I charge a flat fee so they know exactly what they're paying every year. I want, like, part of my goal is to help folks with this financial literacy, and so that they can go out and understand, like, yeah, this person's just selling me an annuity or like a whole life policy, and I don't need that, or they're making a commission off of this product. So anyway, I'm always happy to be a resource and to just have, a 30-minute phone call with folks.
I have a few episodes that dive into the differences between advisors. So I'm happy you mentioned that. It can be a scary world out there.
and advisors in quotations, right? Because like advisor is not a regulated term. Literally anyone can call themselves an advisor, which makes things really scary and hard to navigate unless you know exactly what you're working for. Or looking for.
Well, thank you again. I hope listeners got a better understanding of their equity compensation, maybe some reasons to diversify, some strategies, and the importance of a tax strategist along with your CPA. So until next time, adios.
Thanks.
If you are ever interested in a recap with the main points discussed throughout the podcast episode, check out the Q&A series because we dig deeper into the concepts discussed, and you can follow along on YouTube if that's preferred. If you find any value in the show and want to support it, it would be awesome if you texted someone right now about it. You can say you have a podcast recommendation that you think they should listen to, and then ask them to get back to you with their thoughts. Anything helps, and I really rely on the amazing investors like you to spread the word. Thank you so much for listening, and please feel free to reach out at any time.